Hello, Aaron Ninness here, Denver, Colorado. Thanks for joining me for another episode of How Much Can I Afford? Today's episode is going to be on DTI, and that's not down to do anything. It's actually debt to income, and that's a ratio. Debt to income ratio on personal budget is really the biggest thing that a lender is going to talk to you about for how much you can afford. Here's how it works. We take your gross income, pre-tax income, and multiply it by, in most cases, 45%. Now, the actual range of what that ratio can be goes all the way down to 41%, all the way up to 57%. But we use, for generality, 45%. So, if you had $10,000 in gross income, 45% of that would be $4,500. What that represents is the total amount of outgoing obligations you can have to qualify for a mortgage. Here's how it works. We take the new housing payment, which is the principal and interest, taxes, insurance, and any applicable HOAs. That combined is your mortgage payment. Now, that's also referred to as a front-end ratio, meaning what percent of your total household, gross income is part of that housing payment as a percentage. Then you have the back-end ratio, and that is the debt-to-income ratio. We take the housing payment plus the minimums on all your minimum liabilities, things like student loans, credit cards, car loans, any type of installment loan. Whatever the minimum payment is, we add those together, and what percent of that of your gross income is the debt-to-income ratio. If it's below 45%, in most cases, if you really have decent credit or normal credit, I guess we'll say, you should be able to qualify pretty easily. That's not a given, but that's a good rule of thumb. Now, with the debt-to-income ratio, the housing payment's very easy for us to figure out because those are kind of constants, and that's what a mortgage company is going to be helping you with. But there's a whole nother side of what goes into DTI that's a little bit more open to interpretation. I'll give you some examples. When we talk about student loans are one of those things that someone may come and apply for a mortgage with their student loans actively in deferment, so there is no payment. But all lenders are going to give you some type of payment. Now, depending on what type of loan you're looking at, that's where you start to get into this complexity of the mortgage business, right? For FHA loans, it's 1% of the outstanding balance. If you have $80,000 in student loans, a mortgage lender is going to hit your debt-to-income ratio as if you have an $800, 1%, $800 payment on those. But there's many cases where folks have $80,000. They're not in deferment, but they're on economic repayment plans. Maybe that economic payment based on your current income is $150. Well, $800 is way more than $150, and depending on what type of loan you're applying for, there's a good chance that people, even though it says $150 on your credit report, a lender is going to use $800. Then there's other loan types that allow them to use the $150. So as you start to apply for a mortgage, the debt-to-income ratio is going to be calculated, and that's what's going to drive how expensive of a home you can look at. Now, it's important knowing that debt-to-income ratio is not what you have to go find. If I say that you're qualified for a $3,000 housing payment, but you know your budget is no more than $1,800, that's great. Go find a home that fits your budget of $1,800. You know what the top end is. So it's really just a way to, compartmentalize how much home you can really look for. Now, the ratio also is only taking into account the person who's on the loan. There's all kinds of states around America, obviously, right? We got 50 of them. And some are community property states, some are non-community property states. Here in Colorado, we're a non-community property state, which means that only the person on the loan and their obligations are what we're going to consider in qualifying. My understanding is on states like California or Texas, that may not be the case. Just through marriage, you instantly are obligated on your spouses. But that's not how it is in Colorado. Why that's important is a simple scenario of two people applying for a loan, and maybe we find out through that one's credit isn't good enough. Maybe they had some late payments on a student loan, or they have too much debt, and so they're not going to be on the loan. Now, if that were to occur, what you find is that maybe the household income can handle a budget of $2,200 a month on a payment. That's what the two folks' combined income can allow for. But only one person's on there. So how much can they qualify for? That's where DTI is very important. What if that single borrower can only qualify for $1,800. Even though they have the budget and they feel good about a $2,200 budget, I can't get to that top end point because the debt to income ratio could prevent me. It only is inclusive of just one person's income and just one person's debts in that scenario. So in order to have your debt to income ratio increased, you have to add on another person. And whoever you add on to a loan needs to have more income than they have outgoing debt. Makes sense, right? Okay, so this principle is also the same thing that goes into co-borrowers. Co-borrowers are just a term for someone, mom, dad, grandma, grandpa, usually a family member, signing on the loan to give you additional income. And that's why we add those folks on. They usually have more income than they have in debts. And because we add it all together in this ratio, it usually helps someone qualify for more. That is why debt to income ratios are so important. If you need help figuring out what your debt to income ratio is, obviously you can give me a call. I'm more than happy to help. Shoot me an email and I'll kind of walk you through the process. But establishing what your personal budget is, goal 1, followed by number 2, what is your debt to income ratio? With that, you'll have enough information to go out there and start looking at some homes. The debt to income ratio, on a final note, does differ based on what type of loan you're getting. So don't be surprised if you are told specifically you can qualify for this amount on a conventional loan, this amount on an FHA. That's a very common scenario because they do have different rules based on the loan type. Hope you learned something here today. Keep watching the videos. Make sure you subscribe. Give me a like if you can, and we'll see you on the next episode.